Welcome to MARKETSnap Educational Series, an easy and convenient way of learning basic concepts about investing and financial markets. All explained in an easy and accessible form. The series starts with the basics of investing part. In this fifth video, we will learn about one of the most popular investment products, ETFs. What is an ETF? ETF stands for Exchange Traded Fund, which is a collection of stocks, bonds, or other assets that you can buy and sell on a stock exchange, just like a single stock. In this video, we'll learn more about how ETFs work, the different types of ETFs available, and how to choose the right ETFs for your investment goals. A brief history of ETFs. ETFs were first developed in the 1990s to provide access to passive, indexed funds to individual investors. The concept of index investing dates back further, with the launch of index mutual funds in 1973 by Wells Fargo and American National Bank. The first attempt at an ETF-like product was the launch of index participation shares for the S&P 500 in 1989, but this was ruled to work like futures contracts. The first successful ETF was the SPDR SP 500 ETF, SPY, launched by State Street Global Advisors on January 22, 1993. It is still one of the most popular ETFs today. Nowadays, there are over 8,000 ETFs listed on exchanges around the world. ETFs cover everything, from broad market indices, to niche sectors or alternative asset classes, offering low-cost diversification, trading, and arbitrage options for investors. Since their inception, ETFs have seen tremendous growth and they have played a major role in the democratization of investing. They have made it easier and more affordable for individual investors to invest in a variety of asset classes, and are now used by a diverse range of investors and traders globally. The rise of passive investments. Over the years, passive ETFs have gained more and more popularity over managed funds. To illustrate the significant shift towards passive investment, in 2000, passive funds accounted for only 10% of all mutual fund and ETF assets in the US. By 2010, that figure had risen to 25%, and by 2020, it had reached 45%. In contrast, active funds have seen their market share decline over the same period, and are expected to be overtaken by passive ETFs within 5 years. Here are some of the reasons for the shift to passive ETFs. Lower fees. They are significantly cheaper than actively managed funds because typically they simply track a market index, which makes them easier and less expensive to manage. The average expense ratio for a passive ETF is 0.05%, while the average expense ratio for an actively managed fund is 0.66%. This means that the average passive ETF is over 12 times cheaper than the average actively managed fund. Flexibility. ETFs are traded on stock exchanges, making them easier to buy and sell than traditional mutual funds. Better performance. This could sound counterintuitive, however, research has shown that over the long term, passively managed ETFs tend to outperform actively managed ETFs. A study found that the majority of actively managed funds historically have tended to underperform their benchmarks over short and long-term periods. And the average S&P 500 index fund outperformed 80% of actively managed large-cap funds over the past 10 years. Of course, there are some investors in funds who are able to successfully pick stocks. However, these investors are typically professional investors who have access to a lot of information and resources. For most individual investors, it is better to invest in passive ETFs. Don't worry, while it is true that becoming a consistently successful stock picker is difficult, it is not impossible. In fact, if you continue to follow MARKETSnap, you will have a good chance of learning a tremendous amount of tips and knowledge on how to value stocks. And, if you are willing to put in the effort and dedication to become a successful stock picker, there is a good chance that you will be successful. However, it is important to note that there is no guaranteed way to become a successful stock picker. Even the best investors make mistakes. But, since this is only the basics of investing section of our educational series, let's keep it simple, for now. Next and fourth reason that contributed to the shift to passive investment. Transparency. Passive ETFs are more transparent than actively managed ETFs. This is because passive ETFs simply track a market index, while actively managed ETFs may hold a variety of different investments that are not disclosed to investors. It's also worth mentioning how the endorsement by influential figures add a great impact on this shift. Passive investing has been endorsed, for example, by investors such as Warren Buffett. So, having covered a brief history of ETFs, and the passive investment aspect of them, let's now explore all the different types of ETFs. Types of ETFs. ETFs can be designed to track anything from the price of a single commodity to a large and diverse collection of securities. ETFs can even be designed to track specific investment strategies. There are many types of ETFs to suit different investment goals and preferences. Some of the common ones are: 1. Fixed income ETFs. Fixed income ETFs track a basket of bonds, such as government bonds, corporate bonds, or municipal bonds. These ETFs are a good way to invest in the bond market and earn a steady stream of income. 2. Commodity ETFs. Commodity ETFs track the prices of commodities, such as gold, oil, and wheat. These ETFs can be used to hedge against inflation or to gain exposure to specific commodities, without having to take physical delivery of the commodity. 3. Currency ETFs. Currency ETFs track the exchange rates of different currencies. These ETFs can be used to speculate on currency movements or to hedge against currency risk. 4. Real estate ETFs. Real estate ETFs invest in real estate-related assets, such as REITs, real estate investment trusts, and mortgage-backed securities. These ETFs can be a good way to gain exposure to the real estate market without having to own physical real estate. By the way, I'll do a more in-depth dive on REITs in future videos. So, stay tuned. 5. Equity ETFs. Equity ETFs invest in a basket of company stocks, also known as equities, or shares. They enable you to own part of hundreds, or even thousands of companies in a single trade, without having to pick individual stocks. They are the most common type of ETFs. So why have I listed other types of ETFs first? Well, to now highlight a number of equity ETF subsets types that are worth mentioning, such as sector ETFs. Sector ETFs focus on specific sectors of the economy, such as technology, healthcare, or financials. Thematic ETFs. Thematic ETFs invest in companies that are focused on a specific theme, such as artificial intelligence, cybersecurity, or clean energy. Sector and thematic ETFs allow investors to gain exposure to a particular sector or industry, without having to pick individual stocks. Smart beta ETFs. Smart beta ETFs use alternative weighting schemes to track the performance of an underlying index. For example, a smart beta ETF might weight stocks by their dividends, or their earnings growth potential. Smart beta ETFs can be a good way to invest in a more targeted way than traditional index funds. ESG ETFs. ESG ETFs invest in companies that meet certain environmental, social, and governance (ESG) criteria. ESG ETFs can be a good way to invest in companies that align with your values. Other types of ETFs. 6. Inverse ETFs. Inverse ETFs are designed to move in the opposite direction of the underlying index. For example, an inverse SP 500 ETF would go up in value if the SP 500 index goes down. Inverse ETFs can be used to hedge against market downturns, or to speculate on market declines. 7. Leveraged ETFs. Leveraged ETFs use financial derivatives to amplify the gains and losses of the underlying index. For example, a 2x leveraged SP 500 ETF would go up by 2% if the SP 500 index goes up by 1%. Leveraged ETFs can be used to generate higher returns, but they come with more risk. Leveraged ETFs and inverse ETFs are very different from traditional ETFs. Also, leveraged ETFs that seek to deliver multiples of the daily performance can be both leveraged and inverse. For example, a 3x inverse leveraged ETF on the SP 500 index would seek to triple the daily losses of the SP 500 index. This means that if the SP 500 index goes down by 1%, the 3x inverse leveraged ETF would go up by 3%. It is important to note that leveraged and inverse leveraged ETFs are very risky investments due to their volatility, tracking error, and liquidity risk. Leveraged ETFs typically use a combination of futures contracts and options contracts to achieve their leverage. They are not suitable for all investors, and they should only be used by investors who understand the risks involved. Additional benefits and risks. ETFs offer a number of benefits to investors, including those we've already seen when talking about passive ETFs, such as diversification, low cost, transparency, flexibility, but there are many more. For example, Geographical diversification, which would be otherwise difficult to achieve when investing in individual stocks with a local broker, are tax efficiency. In fact, ETFs are generally more tax efficient than mutual funds because capital gains taxes are only paid on the shares that are sold, not on the dividends that are reinvested. However, ETFs also come with some risks, including those we've already seen when talking about inverse and leveraged ETFs, that they can all apply to ETFs in general, such as market risk, tracking error, fees, and liquidity risk. But now I would like to concentrate a bit more on market risk. Because many investors believe that investing in a simple index fund is just the best, brainless way to go. This has led to ETFs being largely promoted to the average investor for years now, and as we've seen earlier, the size of some major index funds has exploded. However, I would personally argue that, considering the total market valuation, which is very rich compared with the historical average, the looming of a recession, and the divergence between big tech, which is trading rich and maintaining the index's valuation fairly rich, and the rest of the market, especially in some sectors, where many undervalued opportunities can be found. Considering all these factors, index funds could well underperform a stock-picking strategy in the following years. How to pick the right ETF. Here are some tips for picking the right ETF. Identify your investment goals. Are you investing for long-term growth, income, or both? Your goals will guide your choice of ETFs. Consider your risk tolerance. Different ETFs have different levels of risk. Choose ETFs that align with your risk tolerance. Diversify. ETFs already give you diversification, but if you want, you can even buy different types of ETFs in different industries or geographies. Look at the expense ratio. The expense ratio is the annual fee that all funds charge their shareholders. The same index can be tracked by many ETFs, so compare the fees. Check the fund's track record. While past performance is not indicative of future results, it can give you an idea of how the fund has managed risk and returned over time. Understand the index. Most ETFs track a specific index. Make sure you understand what index the ETF is tracking and how it is constructed. Once you have considered these factors, you can start to narrow down your choices and select the ETFs that are right for you. In conclusion, now that you know the basics of ETFs, you can start to consider how to add them to your investment portfolio. Thank you for watching. Please leave a like if you appreciate the educational series. See you on the next video, called, How Stocks Make Money for You. We'll learn about the 3 pillars that drive investment returns. And remember, if you subscribe you won't miss your tomorrow's convenient MarketSnap overview.